Welcome to RFI's Banking Uncovered, the podcast going behind the industry PR, the media spin, the product awards, and the investor reports to look at what's really going on in the customer data, and to ask global thought leaders about their thoughts and views on the future of banking and payments.
Welcome to Banking Uncovered, and this episode I'm delighted to welcome Stefano Colombu to join us for a chat. Stefano is the Managing Director of RFI Global's Asian operations, and as part of that, he oversees surveys of 40,000 consumers across the 10 retail banking markets in Asia and 4,000 SMEs across 5 key banking markets in Asia. As well as that, that data provides in-depth granular insights on up to 50 wealth corridors, and also really importantly on 5 wealth hubs, which is what I'd like to discuss with him today. So welcome to the show, Stefano. Thanks for joining us.
Hi, Charlie. Thank you for having me here.
Great to chat. So let's get right into it. Across Asia, we've seen a significant growth in wealth, both by a volume and a value point of view, both at the emerging affluent end and at the top end, at the mass affluent end. Now, mass affluent customers are much more likely, we know from RFI's data, to hold products overseas and to have cross-border behaviors. What are some of the motivations that are for mass affluent customers to have these cross-border relationships? Is it different to their domestic relationship motivations? Just help give us some insights on that.
Thank you, Charlie. I think this is a very important point because we are seeing the growth of the affluent consumers in having more cross-border banking relationship. This is something that we are capturing across all the markets in Asia. What we are also noticing is that these cross-border banking relationships are mostly driven, for the large majority of the markets, by the desire to gain greater returns on the investment. So we have a large group of mass affluent customers across these markets in Asia looking at overseas markets in order to maximize the investment return. While this is one of the top most important motivations for mass affluent to have this cross-border banking relationship, there are, as always, nuances. We are looking at a wide region like Asia. There are a lot of differences across all the markets, but what we see is that gaining greater returns is one of the key motivations, followed by the need to support business transactions overseas. In markets like Hong Kong and India, for instance, we see a lot of cross-border banking customers having this cross-border banking relationship because they're also entrepreneurs, so they need to facilitate these cross-border banking transactions. And in other markets like the UAE, for instance, the UAE is emerging also as a very important wealth hub in this region. We see that one of the most important motivations is actually because these mass affluent customers, they need to facilitate remittances. They need to transfer money overseas because their family members living abroad, or they're resident, they're citizens of another country.
That's great. So when we're looking at the mass affluent customers, obviously, they've got different motivations. They're growing by volume and value, as we said. But are their behaviors different? Are their pain points different? Are how they transact and their relationships with the bank and the channels they use different? Or is it very similar to domestic consumers and the non-affluent consumer base?
Absolutely, Charlie. No, there are important differences. Again, to start with, in general, we are looking at the cross-border banking customer within the mass affluent segment to represent closely to 20% of this group. And within this group, and when we compare with the total mass affluent, there are important differences in the way how they behave towards their banks. Key statistics on my side, we see that they are more likely to take up new products. There is a much higher product appetite. And this is something, again, cut across all the markets. The mass affluent cross-border banking customer, they show a much higher appetite to take up new products. We're looking at huge differences here because it's 69% for the mass affluent with cross-border banking product. It's only 23% for the mass affluent who are not cross-border banking customer. So we see that there is a much higher appetite, a much higher needs of banking and taking up new products among these mass affluent groups. We also see specific for investment, because also there among the mass affluent customer likely to take up investment product. This number is 37 when we refer to is 37% when we refer to the whole group. We're looking at 47% when we look at the mass affluent customer with cross-border banking relationship. And again, here we said before that you're looking at Asia as a very diverse region. Here is actually something that makes Asia quite a similar region, because this trend is consistent across all the markets that are part of our study in Asia.
Okay, and when we look at where that wealth is going, to and from, and where the corridors of wealth are, as we said at the start, you have access to over to 50 wealth corridors, but the largest one is consistently mainland China to Hong Kong. So what are presumably that's growing, and what are some of the motivations both going from mainland China to Hong Kong and back the other way in that kind of cross-border flow?
Yes, Charlie, it's true. As you said, in our study, we are covering up to 50 corridors, cross-border banking corridors, but definitely China, Hong Kong, and Hong Kong to China is the largest corridor that we see in our study. Another one coming second, close second, is the corridor between the UAE and India. When it comes to China, Hong Kong, and Hong Kong to China, what we have seen this year in our data is that the number of cross-border banking customers has reached a record high in 2024. So we see this strong growth in the corridor, particularly China to Hong Kong. It is really important. It's really interesting to see what makes also these corridors difference, because when it comes to mainland Chinese cross-border banking customers, particularly the affluent banking in Hong Kong, the motivations are mostly driven by investment. They're looking to access banking products, investment products that they might struggle to access in their main market. They want to diversify their portfolio, and again, they want to gain greater return in the investment. When it comes to the Hong Kong mass affluent customer with cross-border banking relationship in mainland China, the motivations are different. Again, it's a very important corridor. It's a large and growing corridor. But in this case, we mostly see entrepreneurs. We mostly see Hong Kong entrepreneurs that they need to have this cross-border banking relationship in mainland China because they need to facilitate business transaction overseas. We also see all the family relationship, the travel relationship. We see that a large group of these customers, they have cross-border banking relationship in China because they travel often there and they want to protect themselves from fluctuation in the exchange products, or they want to access banking products in the mainland.
When we look at the UAE India corridor, which you just mentioned, obviously that's quite a different demographic. So what are some of the motivations there as we're seeing that corridor equally grow both in volume and value?
Again, that's a great question, Charlie. We need to contextualize a little bit. We know that, particularly in the UAE, the cities of Dubai, Abu Dhabi, they are growing exponentially. They're attracting large flows of businesses, investments, and these cities, they need talent in order to fulfill their mission. And most of this talent has been supplied by India. India has an excess of talent, of good quality talent, and these professional Indians are migrating to the UAE, they're migrating to Dubai, they're migrating to Abu Dhabi. And as a result, there is a strong cross-border flow that starts from the UAE and ends back to India. And also that what we are seeing in our data is that this corridor is growing, is increasingly so also more affluent. The remittances, the relationship, the money that is sent back to India is increasingly coming from professionals, from high earners, from entrepreneurs. And the motivations also here are mostly driven by the ties that these people, these expatriates have with their home country. So we see the desire of making investments back to India, or running a small business back to India, or simply sending money back home. So when it comes to this, to the UAE India corridor, we really see the importance of these Indian expatriate communities growing in the UAE, and the need for them to send money back, but also making investments in the country. And we know also India, how much is growing itself in terms of GDP, in terms of the country.
Just sticking with the UAE for a second, because obviously, as well as the 50 corridors of cross-border flows, one of the things you can look at in the data is the big wealth hubs. So the US, Hong Kong, Singapore, UAE, which we've just been discussing. So when we look at those wealth hubs, what are some of the key differences? Where's the money going to and from in each of those wealth hubs?
Again, Charlie, very interesting question because when you look at consumers in Asia, there are certain trends that haven't changed much, I would say. And this, for instance, refers to the US. We know that across all the markets, US is one of the key destinations for these investment. And it is pretty much driven by the importance of the US stock market and how liquid this market is and how accessible this market is from globally, and in particular from the markets here in Asia. The position of the US, although it's kind of losing a little bit of traction for a few reasons. We see, for instance, that all the markets which are near to the Asian markets are growing in terms of attracting investment. This is true for markets like Hong Kong, which is, and it's always been quite of a well-established wealth hub in the region. But similarly, we see Singapore also gaining in importance, and we see the UAE also gaining in importance. So the leadership of the US in terms of wealth hub, in terms of being a destination for investments of these mass affluent customers, is still there, but it's kind of losing a little bit of traction because there is an increased competition from the wealth hubs presence in this region. And there are also there some interesting dynamics. For instance, there are a lot of conversations going on with Taiwan and China. We see that China is increasingly become one of the key destinations for Taiwan for Taiwanese investments in the market. We see the role of Singapore becoming an important wealth hub, not only in the region. It was notoriously a wealth hub for Malaysia, for Indonesia, but increasingly so also for other markets that are starting to look at the stability of Singapore, the regulatory framework of Singapore as a investment center and in turns as a wealth hub. There is also something that there is another trend that we are capturing, which is again the importance of China, because driven by the growth and investment of China in this region, we also see China emerging as one of the most important destination market when it comes to cross-border investments originating from the Asian countries in our study.
What I want to talk about now is the latest share of wallet data that we have, particularly focused on the Singapore market. So obviously, when we look at the share of wallet of the Singaporean consumer, and we look at the differences between the mass market, the emerging affluent, the mass affluent, that's fascinating in itself. But what's really fascinating is the shifts that we're seeing every six months when the data comes out. Who's winning? Who's losing? Who's winning at the expense of who? Who's leaking to who? It's fascinating. So we know that the average mass affluent consumer in Singapore holds about 810,500 Sing dollars across all their share of wallet. And what we can see from the data is, how that composition is between the international banks, the larger regional banks, the local banks, the new digital players. So when we look at that and the latest data for Singapore, who are some of the winners and losers? Who's gaining and who's been losing a little bit?
Yes, Charlie, the share of wallet data, it's really fascinating because this is something that we've introduced recently in our study, but we are now able not only to quantify the number of relationships that each bank has in the market, but also we're able to attach a dollar value to this relationship. How much of the liquidity of the assets banks are able to capture from their customers. And the data is giving us really fascinating pictures because first of all, we can see how much consumers in Singapore are multi-bank. They tend to have multiple relationships with providers in the market. But in particular, we're also starting to capture some interesting trends. The first trend that we're capturing, which is, again, it's fascinating, is we can see how much wealth shifts from the domestic banks to the international banks, the more consumers become wealthier. When we look at the total market numbers, for instance, we see that the domestic bank, they still capture the lion's share of wealth in the market. But as we move towards the affluent segment, the more wealthy consumers, we see that the international banks start to gain much more traction. And when we break further down this data, we see that among the international banks, two in particular are doing a much better job in converting, in capturing most of the wealth of the customer. These two banks are Standard Chartered and HSBC. These two banks also, though, there are some differences as well, because when we look at Standard Chartered, we see that Standard Chartered is doing a great job in converting, in capturing most of the wealth of the clients, although the average mass affluent customer of Standard Chartered tend to be slightly less wealthier than the standard mass affluent customer of HSBC. So while HSBC maybe is doing slightly less better than Standard Chartered in converting the wealth of the customer, they're dealing with a much wealthier clientele. So that's a very fascinating trend. We're also starting to capture some other important data points, as you mentioned before, the digital banks. Singapore has not remained insulated from the growth of digital-only providers when it comes to financial services. We have also here our local champions, the like of Trust Bank, the like of Medibank, GXS. These are providers who have grown a lot in terms of penetration. They were very aggressive in the market in running acquisition campaigns. They managed to convert, they managed to acquire a lot of customers in the market. What we are starting to see recently is that this high penetration in the market is starting to convert also in other assets being captured. They are starting to bite in terms of assets under management, mostly to those banks who notoriously were able to provide high rates on savings and deposit products, particularly the Malaysian banks in this case, the likes of Maybank and CMB. Having said that, when it comes to the penetration, the share of wallet that these digital-only banks are capturing, it remains still small compared to the entire pie that we are seeing in the market.
So overall, would you say, we've had lots of talk across all the markets we looking at the threat of fintechs, the need for banks to create better digitalized services, more personalized services, and obviously the impact on that is particularly acute in Singapore, amongst the neobanks who are focusing on wealth only propositions. Would you say it's perhaps overstated, and it's the international banks and the larger national and regional players who are doing a good job there, or are the fintechs getting as much share of wallet as the media hype would have us understand?
Definitely, we still see, at least here in Singapore, we still see the international banks capturing the lion's share of the share of wallet. Again, we shouldn't underestimate, though, the impact of the digital banks, because they're growing quite fast. They're capturing an increasing number of relationships, and they're also starting to bite when it comes to wealth, particularly that wealth that tends to remain a little bit more liquid of the mass affluent. Think of the time deposits. This is where the digital-only providers, they seems to be having found a way into this quite large wallet when it comes to the mass affluent customers in Singapore.
Okay, I want to move on to the regulators now, because obviously the Singaporean Money Authority, the Hong Kong Money Authority, they're obviously doing everything they can to encourage investments in their markets as a wealth hub, particularly with the accredited investor and professional investor programs. So often when regulators do things, it doesn't necessarily cut through as much as they hope with the consumer. So when we look at high net worth individuals and mass affluent, how successful do you think these programs are, and what are some of the reasons that people are finding an appetite for them based on what we're seeing in the data?
Yes, Charlie, it's true. We see in market like Singapore and Hong Kong. In Singapore, we have the accredited investor program, and in Singapore, we have the professional investor program. These are opt-in programs. Consumers voluntarily decide to opt in and become accredited investors in Singapore or professional investors in Hong Kong. These are programs also where we have seen banks quite occupied in trying to attract consumers, in try to make sure that consumers do opt in into these programs. There are very stringent requirements. These are programs which target mostly the high net worth consumer. These are usually consumers with an assets under management that is above 1 million USD. In our data, what we see in our data is that Singapore seems to be slightly ahead. High net worth consumers in Singapore, they show a much higher awareness when it comes to the accredited investor program compared to high net worth customers in Hong Kong and their relative knowledge of the professional investor program in the market. It is interesting because what attracts the most consumers to opt in for this program is that they know they might have access to more investment opportunities, and they may also be able to have a preferential treatment when it comes to rates, because they might be able to access certain products at a slightly more convenient rate.
I just want to come on to the big elephant in the corner of the room, AI now, or generative AI, because I don't think you can read anything in the media or in social media that isn't talking about AI and the coming AI revolution and the impact it's going to have on every aspect of society. But particularly, in our case, looking at banking. Now with any new technology, there are always the evangelists who are talking about all the positives, and there are also the non-evangelists who are talking about the laggards, potentially you might say, who are talking about security concerns and the dangers and the risks. So when we look at the data around consumer attitudes to AI adoption in banking, what are we seeing? Are we seeing a greater proportion of concerns around security, or are we seeing more people saying, this is all fantastic, looking, can't wait for my bank to adopt more AI into its banking practices?
Yes, absolutely. AI has been all over the place in all the industries, including banking. I think this is something that we wanted to test in our most recent wave of the study, and it is interesting because there is a sense of pragmatism in the Asian consumer, particularly in the Singaporean consumers. And when we ask them, which are the sort of innovation, the sort of interventions where they would like their financial services provider to leverage and use Gen I, we see that they're mostly focusing on fraud. They want banks to step up their ring-fencing, their protection when it comes to fraud detection and prevention. This is the area where consumer they seems to be more comfortable in seeing deployments of Gen I when it comes to the banking services. Again, fraud is a big issue. It's a big theme, I would say globally, but we see it also here in Asia. And I wasn't surprised, for instance, to see consumers showing a much higher degree of comfort if Gen AI solutions are deployed to combat, to fight against fraud. There are other applications in which consumers they tend to show an initial degree of comfort. This is when it comes to predictive analytics, when it comes to chatbot and virtual assistant. But really, consumers here are really pragmatic, are very pragmatic, and they would like to see interventions really going to target fraud detection and preventions. With that, please. Now, with that, what I would like to say is that there are also concerns when it comes to using AI in banking. Security, it's one of it's the top concern. It is interesting here because our conversation was really focused on the mass affluent. What we see is that the mass affluent, they show a lower degree of concern when it comes to AI. There is probably more openness for this group to see interventions in the field of AI from their banks. Something that concern mass affluent more compared to the other groups is the decision making. So they want to make sure that when and if AI would make decision on their behalf, they want this decision to be accurate. So this is where there is also an opportunity for banks to make sure that awareness campaigns and the models and the way how these decisions are made is explained in a much in the best possible way.
And is this, so consumers have concerns about AI. Are there specific things that banks can do to get consumers more comfortable with AI?
Consumers are telling us what I was trying to tell you before. Communications, it's really important. They want to understand how these decisions are made, how these intervention, how these solutions are deployed. Another things that consumer would like to see is the banks themselves making sure that they conduct regular audits, assessments on how these AI are working, and which are the steps they're also taking in order to mitigating all the AI biases. Again, we need to keep in mind that here in Asia, we are mostly looking at markets, communities which are multi-ethnic, and we know that AI has inherently some ethnicity bias in markets like the one that we have in Asia. Making sure that these biases are mitigating becomes one of the top priorities for consumers. It is interesting to see that basically consumers are telling us that they want banks to do their homework and do them well before they would feel comfortable in using AI.
Completely understandable. Okay, we're talking about fraud, and I just want to kind of come full circle and come right back to what we were talking about at the very start, because when we look at the mass affluent cross-border consumer, as you said, they engage more, they have a greater appetite for products, they have a greater appetite for transactions. But we've also got the conundrum of the relationship manager. So the relationship manager is the number one driver of poor performance in NPS across all our markets in Asia. But at the same time, affluent consumers want to do things digitally. And there's also this conundrum for every bank of, I'm an mass affluent consumer. I want to do certain things digitally, and I don't want to have to go to a relationship manager. But at the same time, there are certain things that I do want to go to a relationship manager. And then, to make it even more complex, as much as, consumers are giving banks their wealth, their life savings, their investments. And as much as they want it to be as seamless as possible, the bank has a regulatory and a moral responsibility to make sure that that wealth is secure and any transactions are as secure as possible. In order to do that, they need to put in certain things which create friction. So just as the mass affluent consumer is looking for a frictionless experience in order to combat cybersecurity and fraud, banks are having to create some levels of friction. So how do you think banks should deal with that? And also, what is the ideal trade-off if you're looking at a wealth management proposition between, a relationship manager and digital? What's the panacea that will solve that conundrum for banks?
Um, Very, very good question. Very interesting question, Charlie. It is $1 million question. What we see, what consumers are telling us is that it is true. When it comes to the RM, there are certain pain points which are felt across the market, and they are important drivers of relationship. At times also an important relationship, a priority banking, a private banking relationship might stop due to the performance of the RM. There are important differences here. Also, when it comes to the digital channel, what we see is that consumers, they want to be digital. This is true not only for the mass affluent, but also when we look at the high network consumers, increasingly so, they are becoming more and more comfortable in using digital channel, and their appetite for digital experiences continues to grow. We keep telling to our clients is that this group of customers are money rich but time poor, and hence really the importance of catering, providing important and consistent and robust digital experiences. When it comes to DRM, the pain points that we find, areas where banks can try to improve and optimize this aspect of the performance and the relationship is in the proactiveness. At times they're not as proactive as the customer in their portfolio would expect to. There are some pain points also when it comes to the quality of the financial review and also the availability. So being there, being present, making sure that the customer is really kept at the center of the relationship. This is what RM should be doing in the market. And this is where banks, we feel, have an opportunity to step up the experience that they offer through the RM. When it comes to the mobile banking, when it comes to the digital channel, it's really more transactional. But increasingly so, we see consumers relying on the digital channel also for advice and education. So the importance of the updates, the insights that are provided through the mobile banking app are becoming really important, particularly the insights also which are connected to the investments, the daily update, the weekly update, the quarterly update. This is something that consumers, particularly those who are more savvy, more engaged with their investments, they are expecting from the bank, and they look forward for the notifications in their mobile banking app. So here is what we see. The importance of the RM in terms of delivering that customer centricity, the importance of the digital banking channel to be there day to day to facilitate the transaction, to also provide advice and guidance when it comes to the investments.
Okay, fantastic. One last question for you, Stefano. I know you've just been recently updating the RFI's Global Trends and Predictions report with a short video, and in that you talk about the emerging affluent, which is one topic we haven't focused on so far in the chat. So when we look at the emerging affluent, it's obviously a very fast growing section, particularly across the Asia Pacific region. You know, what's your prediction for the future when it comes to the emerging affluent?
This is a very interesting question, Charlie. And as you said, this is something that we cover in our trends and prediction at the beginning of the year. The emerging affluent is a very important segment because it is at the emerging affluent stage where consumers start to make important decisions about their banking relationship. It's at the emerging affluent level where they decide with whom they want to consolidate the banking relationship. We know that once they become mass affluent, they tend to consolidate most of the holdings with one main bank, and then they might be using secondary banks for more transactional sort of solution. But it's at the emerging affluent level and the early level of the mass affluent where they make these decisions. So when it comes to grow the customer, when it comes to grow the wealth of the customer, banks they really need to pay attention at that emerging affluent level, because this is where these consumers are taking important decisions. What we see in our data also is that there is an appetite among a certain group of emerging affluent customers to be part of those premium accounts, priority banking, premium banking. Also, that the requirement for these programs at times might be set too high in certain markets. If it's possible to think of intermediate layers, intermediate programs, this is something that a certain group of customers, particularly the emerging affluent level, would be interested in signing up, because there is appetite also to have a more premium, a more dedicated experience as they grow their wealth.
Fantastic. Stefano Colombu, thank you very much for your time. For anybody who's interested in that huge amount of data that Stefano's just alluded to in all those topics, then please reach out to the RFI team in Asia or to Stefano directly. But thank you very much for your time, and thank you for sharing those insights with us.
Thank you so much, Charlie. Thank you for having me on the show.